A survey of British consumer confidence held steady last month. Despite increased fears about the state of the economy, will join us now to discuss is Sarah Hewin, economist over at Standard Chartered. Sarah, thanks very much for joining us today. Well, that confidence plus the fact it appears that the housing market, according to the Nationwide, is showing tentative signs of improvement. Does this mean the UK consumer is back?
Well, I think it's a matter of two steps forward, one step back, really. The housing data are starting to improve. We've seen a pickup in buyer inquiries for a number of months now. But I think that in terms of house prices, it seems to be the case that it's restricted supply that is really underpinning the latest rise in prices. People are reluctant to put their properties on the market. The home information pack came into being as well recently. So these are factors that are restricting supply and perhaps falsely pushing up prices. In terms of consumer confidence, I mean, we have seen a sort of steady rise over the last few months, but flattening out this time round. So I think we do need to be a bit cautious about calling for a return of the UK consumer. I mean, we have seen a pickup in retail sales. Certainly the BRC, the CBI distributed trades number looked a lot better. But we're seeing rising unemployment, continued distress, rising bankruptcies, and I think that these are going to be factors that will persist for quite some time yet. So too early to call a big return to the consumer. Yeah,
but too early to call, and yet the currency has had such a wonderful rally. I mean, it's ignoring some of those factors you mentioned about personal insolvencies, about corporate insolvencies, about concerns about AAA ratings. Now, why are we above 160, and why is it improving against a lot of other currencies?
Well, of course, sterling took a huge hit, and we're still a long way below where we were just a year ago. So I think that there's an element of regaining some of the lost ground just over the last few weeks. It's interesting, there are two factors that are sort of pulling and pushing sterling. For the moment, markets are really ignoring the debt blowout that we're facing. They've sort of pretty much shrugged aside the S&P warnings. And I think focusing on some of the green shoots that are appearing in the economy. But I think it's very much a dollar story as well, that the repatriation of funds that we saw to the US when things were really bad in the global economy, those are starting to reverse now, and that's helping sterling, helping the euro, helping other currencies as well.
It's interesting, Sarah, the economy in the U.S., a lot of people hoping that it's going to reverse course. We'll have a revised first quarter number today. The estimate is from minus 5.5% from minus 6.1. I mean, ultimately, when do you think that the U.S. economy is going to turn around, given the dollar headwinds that you're calling for?
Well, we're still seeing a downturn in inventory, and I think that even though the slightly improved number that we're expecting this afternoon will be on the back of better trade, inventory declined quite not so bad as had originally been expected. Q2 looks set to be another bad number for further decline in inventory. The reversal of the inventory cycle should help GDP to start to pick up in the second half of the year, however. So we're looking for a turnaround in the economy sometime around sort of Q3, Q4. Having said that, though, there are still very many headwinds. The global economy is still rather weak. Consumers in the US are also facing problems. Unemployment will be rising for some time yet. So we think that there's going to be rather muted recovery rather than a strong rebound of the sort that we normally get after recession.
What do you think the greatest risk is out there? It seems like that's almost the consensus, that everybody's looking for a gradual, muted recovery in the second half or early next year. What's the risk?
Well, I think we feel that the risks are to the downside. There's a chance that you could get quite a strong lift from inventory, so that's the sort of the upside risk. But our view is that if we do get an inventory-supported rebound in GDP in the second half of the year, this will be short-lived, and we would see a pullback again. I think the risks to the downside are still very much that the sort of financial market stresses have not completely disappeared. There are sort of growing concerns about the size of the US budget deficit, the US debt, and that may end up leaving Treasury yields somewhat higher than they are even now. So we could see the sort of recovery being cut short as a result of rising Treasury, rising mortgage rates.
Sarah, Sarah, we also had some economic data out this week in Japan, and today's numbers on industrial production were not very surprising given the turnaround we saw, or at least the stabilization we saw on the trade front in Japan earlier this week. At this point right now, where does Japan's economy go?
Well, again, I mean, we've certainly seen some strong sort of green shoots from Japan, and I think that we're going to see more of those coming through in the next few months. But the economy still has to work through the recession. So for the moment, we're still expecting to see negative growth continuing in the next couple of quarters. But the strong regional stimulus, of course, should help to have an impact. We're already seeing that that's having an impact now on Japan's exports. So our view is that Asia is going to come out of this downturn more quickly and in better shape than the West. So the Standard Chartered view is that Asia is the place to be.